A very good morning to our MIIM members and our friends in Germany, and a very good afternoon to the Indian industry. Thank you for joining us today for this important and relevant webinar on Decoding the Union Budget 2023, being organized under the Make in India Mittelstand program in association with our eminent partners, Khaitan & Co. and Rödl & Partner. Rödl & Partner is a knowledge partner for the MIIM program, and I'm Jamli John, responsible for business development and PR for Rödl & Partner office in India, and I'll take you through the session today. Before we continue with the session, let me briefly explain on the technical side of our program. The following functions are available to you. In the upper right-hand corner of your screen, you will find the control panel, and here you can adjust the audio settings and choose, for example, between your headset or the computer audio. Please note that as a participant, you are muted by default. A further bit down your dashboard, you'll also find the question panel. We will request the attendees to kindly post your questions here, and we'll take up the questions in the last leg of the webinar, that's during the Q&A session. Just to give you an overview on the MIIM program, MIIM is an initiative of the Department of Promotion of Industry and Internal Trade, DPIIT, and the Embassy of India, Berlin. MIIM provides a platform that integrates a wide range of support services for German Mittelstand companies and family-owned enterprises. It is part of the Make in India initiative of the Government of India and is a program designed to facilitate investment, foster innovation, enhance skill development, and protect intellectual property and build best-in-class manufacturing infrastructure. The MIIM program offers all support services like strategy consulting, M&A, operational market entry support, tax and legal support, financial services, project financing, location services, technology collaboration, facilitation of approvals from central and state government agencies under a single umbrella. Part of the MIIM program is today's informative webinar, which we hold for the topic Decoding the Budget 2023. Being the last full-fledged budget before the election here, there were huge expectations from the Union Budget 2023 presented by the Honorable Finance Minister on the 1st of February 2023. The budget was presented in the backdrop of the impact of the world economy due to the Russian-Ukraine war, global recession, and the need for job creation. India has been considered as the bright spot with the estimated nominal GDP growth of 7%, which is the highest amongst the major economies of the world. According to the projections of the World Economic Outlook, India's GDP is expected to grow at USD 5.4 trillion by 2027, making it the third largest economy in the world. Increasing tax collections and increase in the per capita is expected to bring down the fiscal deficit to 5.9% for the financial year 2023-24. The Union Budget has also introduced various physical developments measures where the capital expenditure is increased sharply by 33% to INR 10 trillion. The government has emphasized on the vision to make the nation technology-driven and build a powerful knowledge-based economy by focusing on promotion of artificial intelligence and securing online storing and data sharing of documents. Apart from these announcements, there have been several other changes which have been put in the tax and regulatory framework and also proposed, and which our speakers today will enlighten us and give us more details. We are pleased to welcome our speakers from the Rödl & Partner team and Khaitan & Co. today. We will begin with an overview, the economic overview and the details on the direct tax from our colleague, Mr. Gaurav Makhijani, who is the associate partner from the tax side from Rödl & Partner. With no further delay, I'd like to hand it over to you, Gaurav. Thank you.
Thank you, Jamli. I'll just present my screen. Good morning to our colleagues joining us from Germany, and good afternoon to people joining us from India and other region. Without wasting time, I'll go on directly to the economic overview of the budget 2023, which was presented on 1st February. Now, as Jamli covered most of the point on the important aspect of budget, that the nominal GDP growth of India is expected to be 7% in 2022-23, which is highest among the major economies. And India, as you may already been heard in news channel and the media articles, that it is already the 5th largest economy in the world, and by 2027, it's looking at to become a 3rd largest economy in the world. Now, in terms of FDI, the figures were that the net FDI for this year was $34.36 billion US, which was among the top 10 global recipients of FDI. And also, as Jamli mentioned about the fiscal deficit, this is supposed to be around 5% in current year, and government is willing to bring it down further by 2025-26 to 4.5%. As you can also see on the screen, there is a graph where you see in financial year 2021, which was a period for COVID, there was an increase in fiscal deficit and there was a lot of pressure on the government. But now it's after 2022, you see a declining trend, and therefore 4.5% is being expected by 25-26. We also see a decline in the CPI inflation, which was quite high the first half of 2022 because of the conflict, but we see a declining trend again after September 2022, which is again a positive sign for the Indian economy. In terms of priority sector, the government has divided the budget into two parts. One is the priority sector for current year, which is 23-24, and also government has identified 4 focus area, which it's looking for the 100-year of independence by 2047, what exactly they want to achieve. And more importantly, in this slide or in this area, one should focus on the focus on the infrastructure development, the green and the clean energy which India is focused on, and also with the inclusion development and reaching the last mile, where inclusive development of all the states of Indian government is something which is being planned. In terms of other highlight, we see that the major boost or providing impetus to the industry, there is an investment of infrastructure. We see that it would be 3.3% of GDP, which has been planned. Also, in the for promoting the clean energy, we see the energy transition. The budget provides for 350 billion on the priority investment of clean energy. There are certain other aspects in terms of logistic. New logistic policy was also introduced, and 750 billion on the investment on the logistic would also is planned for this year budget program. Now, coming on to the direct tax proposal part of it, first I'll cover the individual taxation. In financial year 2020, the Union Budget 2020, the Indian government has introduced a new regime for personal, where certain different twinkling was done with the tax slab rates, where different tax slabs rate was provided as compared to the old tax regime. And if you see the screen, there are three column which we have provided. One is the old regime, which was the default regime till last year, and then there was a new regime which was introduced in financial year 2020 onwards. But the people were not very happy, or the taxpayer were not very happy with the new regime, because the ultimate effective tax rate as compared to the new regime and old regime, the old regime still continue to be more beneficial. So the government has made some certain changes in the slab rates and also introduced certain provision. If you see on the right hand side, I have mentioned the important points, and the net result is that now they are bringing it par, the new regime and the old regime, and the plan seems like they'll slowly phase out the old regime and would stick to or continue with the new regime. The idea is that they want to do away with those areas where there were litigation or certain documentation which were required to be submitted, which was a tedious task for personal. And the idea is that they'll take away certain exemption and deduction, but will provide the lower tax slab rate, so that the effective tax rate at the end of the day is at par. Now, the most important point which we have to note in the new regime for current year is that now this would be the default tax regime, and if any taxpayer has to again opt for this old regime, they have to choose before filing the tax return. In this case, up to 700,000 INR, if any individual is earning in India, then they would not be required to pay any taxes. So there is a rebate provided, which was earlier for 500,000. For old regime, is still continue to be 500,000, but for new regime, this has been increased to 700,000 from financial year 23-24. Also, if you see, highest applicable surcharge rate has been reduced from 37% to 25% for tax bracket, which increase over and above INR 50 million for the new regime. So again, for super rich tax, the new regime is more beneficial because of the capping and the surcharge. Now, for salaried and pensioner, this is very important that the standard deduction of INR 50,000, which was available in the old regime, has now also been introduced in the new regime. So therefore, for salary taxpayer also, this new regime becomes a little more beneficial than the existing provision. Just to provide you in perspective or provide you a brief overview of what exactly it means for you. So we have provided by a way of example. If, for example, in the table 1, you see if you are not claiming any deduction, and if you are earning income up to INR 1 million, in the old regime you have to pay a net tax of 117,000, while in the new regime it's 62,400. Similarly, in table 2, we have considered that you take a deduction of, say, INR 150,000 under ETC, which means a contribution to Provident Fund or LIC or similar payments which are applicable for ETC deduction, and also taking claim of 200,000 of interest on housing loan. So in that case, if you are earning, say, in second row 1.5 million INR as a salary, and then in that case, old regime, you'll have to pay a net tax of 163,800, whereas in new regime, it's 156,000. So you have again tax saving in the new regime if you are earning more than 1.5 million. Here we need to see that we have not considered HRA, which again is something which is substantially taken by a lot of salaried class employee. So there you'll have to still consider if you are claiming HRA, whether old regime would be beneficial or new regime would be beneficial. But as a key takeaway, the idea is that the new regime is now much more beneficial than what it was, and the government seems like they'll phase out the old regime in due course. On the individual taxation front, we see few other changes as well. Like there was a case where few taxpayers were taking an aggressive position on the interest on housing loan. So once you actually obtain a loan and you pay interest on that, you that interest on housing loan was considered as a tax deductible item while computing the income from house property. But few taxpayers, what they were doing was when they were actually selling out their property in future, they were also taking this benefit of interest as a cost of acquisition or cost of improvement while transferring the house property. So this tantamount to the double deduction. So government has clarified that if you have already taken interest on housing loan while computing income from house property, then this would not be considered again as a part of cost of acquisition and cost of improvement. So again, a clarificatory amendment to reduce the tax litigation. Then on the leave encashment side, the exemption has been increased from INR 300,000 to INR 2.5 million. The rules and notification will be provided in due course, but this is again for the non-government employee and a welcome move, as this would increase the tax exemption limit for employees. Earlier, in previous year, government has introduced a new law wherein if any resident is providing any gift to a non-resident that was deemed to be taxable or an income generated out of India, but similar provision was not introduced for a not ordinary resident. So now government has clarified that even in that case where gift is provided from a resident to a non-ordinary resident, this would be covered as a deemed income and should be subject to tax in India. Moving on further on the capital gain taxation aspect, there's a deduction under section 54 and 54F, which one can purchase if somebody has a capital gain in a particular year and then invest that particular capital gain in a house property, then they used to get a deduction. Now, government was seeing that this was being used because this particular deduction was provided to promote the housing for all scheme of the government, but they were seeing that because of this deduction, a lot of taxpayers were actually using it as an investment mechanism by investing into the real estate property and reducing their capital gain tax outflow. So the government has just put a cap on this deduction of up to INR 100 million, so as to avoid this being used as a investment mechanism, rather promoting it as a housing for all mechanism scheme. Again, a lot of company we see are providing to their employee rent-free accommodation, specifically the executive class of the employees. So government has noted that there's no clarity on how this particular rent-free accommodation is computed. There are certain provision in the law, but there are still a lot of litigation around this. So government has said that they'll come out with the prescribed rule so as to reduce the litigation on that front also. Now, moving on to the corporate tax rate, we see that there is no change in the corporate tax rate for financial year 23-24. But still, having said that, we again see that India is still, if you see the corporate tax rate, still at the lowest bracket under the Asia Pacific. So it's still one of the favorite investment destination for all the foreign investor into India. As we see that in 2019, there were reduction in the corporate tax rates of a domestic company to around 25%, and for manufacturing company, which has been set up after 1st October 2019, but commences this manufacturing before 31st March 2024, they are entitled to even further lower corporate tax rate of 17%. Here, I would like to highlight that for manufacturing company, the real expectation actually was that this particular sunset clause, where they say that the manufacturing should commence before 31st March 2024, it was expected by the industry that this would be further extended, because earlier this date was actually 2023, but because of the COVID situation, this was extended to 2024. And because of this conflict, the focus was shifted. So really the idea of the industry was, or the expectation was, that because India is also looking at the change in the supply chain structure, so the idea really was that this would be extended. But in this budget, sadly, we do not see any change in this. A lot of budget representation have been made to the government, and therefore we do hope that this would be something which would be taken up by the government in future. Moving on to the further amendment now, there was a provision under section 194R which provided that whenever a company is providing any benefit or perquisite, be it in kind or in cash, TDS would be applicable. And also under the act, it was clear that any benefit or perquisite should be taxable as a business income. Now, there was a confusion because of a Supreme Court judgment which said that if there is a benefit in kind, that is something which is specifically provided under the law, and therefore it should be taxable. But all the benefit or perquisite which are provided in cash is not specifically covered under the law, and therefore should not be taxed as business income. Now, the government has clarified that aspect, that any benefit or perquisite given in the business, in the course of business, be it in kind or in cash, this is something which would be taxable as a business income. So this is just a clarificatory amendment brought by the government. On capital asset intangible issue, so there was a issue where any intangible was purchased and there was no purchase consideration which could be attached to it. And when were actually selling that capital gain, the taxpayer used to argue that because there's no cost of acquisition which is determinate, and therefore we cannot actually compute the capital gain tax. And therefore, using the Supreme Court judgment of PC Srinivasa and Sethi, they actually used to contend that because capital gain cannot be computed, the entire mechanism of capital gain fails, and therefore nothing should be taxable uh, in such cases. So the government has clarified to cover these aspects into tax ambit, that any intangible where you do not have any direct purchase consideration attached, or you cannot determine, this would be deemed to be as nil, and therefore all the income which you are earning by transfer of such intangible, that would be considered as capital gain and tax accordingly. On the next point of tax credit mismatch, this is again a very important and clarificatory amendment brought by the government. I'll explain this with the help of an example. What used to happen was that in, for example, year one, you are disclosing any income. However, while making the payment, the TDS is deducted in year two. So that used to lead to a mismatch for which the tax authority were never providing TDS credit in year one, because this was being appeared in form 26 years of the taxpayer in year two, and year two, because you have not disclosed that income in year two or offered to tax that year in income in year two, the tax authority used to say that because this pertains to previous year, will not provide the tax credit. So because of this, there was always a TDS credit loss to the taxpayer. So the government has now clarified that in such cases where there is a mismatch and income has been offered to in year one and TDS credit is appearing in year two, the taxpayer has an option to file a rectification, and the tax authority would provide TDS credit in the year in which such income has been offered to tax. Now, the exact rules would be provided later, but this is something which is again a welcome move and avoiding such tax credit loss to the taxpayer. On the next amendment on the share premium received from non-resident, now this was already applicable for resident. Whenever any company, Indian company, used to issue a share, the value of which was in excess of the fair market value, then such excess amount was taxable in the hands of the company which was issuing shares. But this was applicable only for resident. Now they have made it applicable for non-resident also. So this could lead to further tax litigation, because at times whenever there is a share premium involved, you need to have a valuation also from FEMA perspective and company law perspective. However, the valuation methodology provided in the FEMA is DCF method, where even a certificate from chartered accountant is fine. But under this provision specifically, it provides that the valuation should be obtained from merchant banker. And whenever there is any valuation aspect involved and this amount is subject to tax, the tax authority may also go into valuation and challenge the valuation itself. So again, this is something which was still yet not a concern for the industry, but because of this amendment, maybe a little concern, and a lot of planning or careful consideration should be done whenever any company is issuing further share. On the next amendment on the MSME, now just to promote and give benefit to MSME, government has said that any payment which is being made to MSME, the tax deduction for that amount should be allowed only on the payment basis under section 43B. Again, on the last amendment on this slide, there were certain preliminary expenses. Now, these expenses are expenses which are incurred before the commencement of business and are provided on 1/5 basis for continuous 5 years. And for claiming those expenditure, it's important that we have a qualifying expenditure. So there are certain identified expenditure which can be claimed as a preliminary expenditure. Now, on one such expenditure, really, if you are taking a feasibility study or a project report, the rule said that either this feasibility study or project report could be done by you, and therefore all the expenditure would qualify as a qualifying expenditure for preliminary expenditure, or you give this work to any entity which is authorized by CBDT or a Central Board of Direct Taxes. To remove this challenge where you are required to find an entity approved by CBDT, government has clarified that either this feasibility study or project report can be done by you, or you give it to any other entity. It should not now be required that this entity is approved by CBDT. So this would definitely lead to some ease of doing business for taxpayer. Moving on to certain procedural aspect which government has introduced on the corporate tax side. So on the reassessment matter, generally we saw that there was no actual time limit where a taxpayer was required to file a tax return. Usually when a reassessment notice was issued, the first notice when it was sent to the taxpayer, the tax officer used to ask the taxpayer to file a tax return, but they used to provide 30 days time, or it was at their discretion. It was not there in the law. So to clarify and to provide certainty in the law itself, the government has provided that in such cases, the tax return needs to be filed within 3 months from the end of the month where notice is issued, or on the time which is extended by such tax officer. On the next amendment, now there were two different set of amendment on the refund aspect. One was that whenever you have a refund under section 143(1), where a return is filed and then it's processed, a refund is determined. If a tax officer feels that there could be a certain tax demand, they had a power to withhold tax refund. And there was a different provision which provide that if you have an outstanding tax, then any tax refund which is determined by the tax officer, then that can be adjusted by the tax officer by giving due consideration and also opportunity of being heard to the taxpayer. So the government has, to clarify and make the law easy to read, they have just combined these two sections. But because of this, the only important point which we need to, or which impacts the industry, is that the interest on tax refund, which was earlier available from the date of processing of the tax return till the assessment finalization, would now not be available. So this time lapse of the interest is something which is taken away by the government with this combining of two provision for interest on refund. On the next amendment on the prevention of inventory undervaluation, government noted that there was certain complexity while valuation of inventory by certain taxpayer, and therefore government has introduced a provision under the law wherein they have given the power to the tax officer that in case they feel that any taxpayer it's in the inventory is little complicated, and if they have a doubt that this may be undervalued, then they can refer the matter to a cost accountant. The cost etc would be borne by cost account the central government, and then they will provide the report to the tax officer, basis which the final assessment would be carried out. Now, we have noted that there is a similar provision under the law wherein if the accounts are complicated, the government or the tax officer can refer the case to a special auditor also, which leads to a lot of complication because they go into various detail and it takes a lot of time and effort to actually go through all those documentation, and the SSC's times is also required. So this is something which is again very, very challenging and could prove to be a time consuming task for taxpayer. On the next amendment on the time limit for scrutiny assessment, the government has again changed the date of completing the tax scrutiny from 9 months, which was introduced last year only, to 12 months from the end of assessment year. So this is again a very, very procedural amendment, which is relevant primarily for the tax officer, but this is something which also needs to keep to be mind by the taxpayer, that this is something which would be provided by tax officer to conclude a tax scrutiny proceeding. On the modified tax return, also government has clarified that the procedure of what needs to be done by the tax officer once the modified return is filed. And this is applicable in the case where there is, for example, a merger or a restructuring done and the order from NCLT has been issued. On other corporate tax matter, now on the TDS default, a certain new provision was introduced last year, for example, TDS on virtual digital assets such as cryptocurrencies, or TDS on perquisite, as I discussed on the perquisite point. But there were no similar change made on the penalty provision. That meant that even if there is a default in TDS, penalty cannot be initiated by the tax officer. The government has clarified now that penalty can be issued for those TDS default as well, and they have made the suitable amendment on the penalty provision for those two TDS provision. Again, a clarificatory provision on the updated tax return. There was confusion whether advanced tax is to be considered while computing the interest under section 234B. So government has clarified that yes, advanced tax, if any paid, should be considered while computing 234B interest, even if there is an updated tax return filed by the taxpayer. Few other amendment like presumptive scheme threshold has been extended or increased from 20 million to 30 million for small taxpayer, and for professional, certain profession specified under the law, this limit has been increased from 5 million to 7.5. This is not relevant for foreign investment company into India, so I'm not covering this aspect in detail. Again, a clarificatory provision of allowing appeal that can be filed. So there were certain changes provided by the previous year law, which provided that even commissioner can file, can pass certain order, but there were no provision which was allowed that this order can be appealable. So the government has clarified and included, made certain suitable amendment so that all those orders which are passed by the commissioner appeal can also be appealed against the higher authority. Important point to note here is that they have also allowed filing of cross objection for all classes. So earlier, when any appeal was filed before appellate tribunal, income tax appellate tribunal, or ITT as we call it, there were confusion whether cross objection can be filed by a department or a SSC. So government has clarified that for all the appeal which are now filed, this cross objection mechanism or option would be available to all taxpayers. Certain changes in the TDS provision was also introduced. For example, last year the government has introduced that higher TDS rate would be applicable on the case where there were non-filer of tax return. The government has already clarified that if there is a case of non-resident which are not having any permanent establishment in India, those taxpayer would not be considered as non-filer, or the higher TDS rate would not be applicable on them. So the government has now clarified that they have right or power to introduce certain other class of person also in this. Nothing has been notified yet, but they have just extended or specified this power. On the TCS front, they have increased the rate of TCS from 5% to 20% on the overseas tour package and LRS remittances, except the education and medical remittances. So overseas tour package and other remittances, the cost may go high for taxpayer in India. TDS exemption, which was earlier available on interest on listed debenture, is now removed. And the basic concept is that these are in the form of derivative and not on the equity front. So TDS exemption should not be available on those. On the next slide, I've covered certain benefit which has been provided to startup. So for claiming a tax holiday for startup, the eligibility criteria provided that the startup should be incorporated before 31st March 2023. Now this has been extended to 31st March 2024 to promote startup in India. And also similar provision where a carry forward or setup of losses was provided up to 7 years. Now this has been extended to 10 years from existing 7 years. Now, this was all on the corporate tax front. However, there were certain other comments which are relevant to note on the union budget from corporate tax front. Finance Minister actually announced that there would be certain next generation common ITR which will be introduced. So now currently we have 7 different ITR for different class of taxpayer. The Finance Minister announced that there would be one common ITR which would be introduced, and this would promote the ease of doing business because this would sort of facilitate the pre-filled ITR, and whatever information which tax department already has would be something which they would use and then provide utility which would be more easier to file by the taxpayer. But this is something which is yet to be introduced. PAN would be used as a common business identifier, which is again could help in a lot of KYC related documents and other aspects in terms of corporate governance. Now, one thing on the last point I've already covered, that manufacturing entity, the lower beneficial tax rate of 15% is something which is applicable only if the manufacturing of an entity commences by 31st March 2024. This was expected that this date would be extended, but this is something which is not extended. So this is something which would be taken up in the post-budget memorandum, and we are looking to see if there are any changes brought by the government after in the actual act before the enactment. Similarly, there was a lower tax rate of 5% on interest on foreign currency borrowing or investment, and the sunset clause was provided for 30th June 2023. So any loan in foreign currency which was provided by 30th June 2023, interest of lower tax rate of 5% was applicable on interest. But any such loan which is taken after 30th June 2023, a higher tax rate of 20% under the Indian domestic tax law, or for example, under India-Germany tax treaty, it's 10%. So higher tax rate would apply. It was expected that this would also be extended, but this is again not extended and is forming part of the budget representation by various industry bodies. On transfer pricing front also, one very important amendment has been introduced. Earlier, whenever the transfer pricing audit scrutiny was initiated, the transfer pricing officer used to provide a 30 days timeline to submit the local file or transfer pricing documentation, as we locally call it. And then this timeline could further be extended by 30 days. Now, usually transfer pricing documentation is something which is expected under the law to be completed and prepared before filing the transfer pricing report in Form 3CB. But what we have seen is a lot of taxpayer, because you get 60 days, that is 30 days plus extended 30 days time. So a lot of taxpayer were not preparing the transfer pricing documentation or local file at the time of filing Form 3CB, but usually were preparing this transfer pricing documentation if they were receiving any notices from transfer pricing officers. So government has taken a note of this and seen that this practice was prevailing. So to avoid this situation, the government has now reduced the date from 30 days to 10 days. So it's actually very, very important for all the multinational companies in India that if they have an international transaction and they are required to prepare transfer pricing documentation or local file, they should complete so before filing Form 3CB. Now, this was it for corporate tax and transfer pricing amendment. I'm happy to take any questions at the end of the webinar.
Thank
Over to you,
you
Evan.
so much. Yeah, thanks so much, Gaurav, for that insights. Of course, we will take the questions during the last leg so that it'll be easier to take it all together with the speakers together. I'd like to now welcome our next speaker for today, who is Mr. Udayan Choksi, the partner for indirect tax at Khaitan & Co. from Mumbai. He shall give us an overview on the indirect tax perspective. Over to you, Mr. Choksi, for the presentation.
Thank you, Jamni, for that introduction. Good morning to our colleagues joining from Germany, and good afternoon for those who are in India. Let me start talking about the GST amendments, perhaps with a little bit of background first, in terms of what's the environment we're dealing with, and what's the context in which we've seen some of the amendments that we have. So since GST was introduced in 2017, we've seen a fairly maturing environment. We've had some key issues settled by the Supreme Court. And if I were to just run the top of the list names, we had Philco, where the issue of Tran-1 credit, the transition credit from the pre-GST regime to the GST regime, got settled late last year. A consequence of that was that several of you might have filed revised Tran-1 forms to transition that credit. We are, in fact, facing some issues, as some of you might already be encountering, in terms of how the department is actually processing the revised Tran-1 forms which are being filed. But nonetheless, that was a key issue that the Supreme Court settled. We wait with bated breath to see what the Supreme Court rules in safari retreats. That was the case which went up from the Orissa High Court on the issue of block credits in the context of construction. That, of course, impacts several industries and several business segments. And we did have a rare favorable judgment from the Orissa High Court, which the department challenged, and we now wait to hear from the Supreme Court. The hearings have been completed and the order is expected pretty soon. On the issue of anti-profit hearing, which has also been a fairly vexed issue, the Delhi High Court is actively hearing the parties on the constitutionality of the anti-profit hearing provisions. And in the course of this year, we'll be finding out more about what the court thinks of that. And finally, we've seen some retrospective amendments, and several of them have actually been simplifications and in line with what industry had wanted and industry had expected. And therefore, that maturing in terms of the evolution of the law, we are actually seeing the government take steps to ease business and remove some uncertainties. We've had record collections month on month as India has come out of COVID. It's fairly standard now to have 1.5 lakh crores, which is about, I think, 16 billion euros a month. That's what our tax collection is. We also deal with a tightening of the credit mechanism. So from the 2017, the matching process which was to happen, we now have the Form 2B, which needs to be used. All credits needs to be matched. And therefore, that's been one of the, one might say, negatives in terms of the strictness with which the credit matching has been enforced. And finally, increased audit and surveillance, that despite having record collections, as late as last weekend when the GST Council met for the last time, they talked about the increasing amount of frauds that they see happening. And therefore, we're dealing with record collections on the one hand, and yet increased audit and surveillance and that environment. Several of you might have faced audits. Several of you might be facing investigations and summons and so on. So with this background, what people were looking for and trying to see in the budget was how many of these long pending issues get resolved. Do several of the offenses get decriminalized? That's been an initiative of the government. In fact, the Honorable Finance Minister mentioned that in her speech. That's been part of the government's larger mandate, especially as India looks to increase its interactions with the rest of the world. And the other on this issue of opening up of credits. Indian GST has been a flawed credit in terms of some of the restrictions that our creditors have placed, and industry was looking for relaxations on that count. So what we'll see, and I'll run you through some of the key changes of, given that background and given these expectations, some of these things have, borne fruit, have been as per expectations, and some have been somewhat surprising. So the first is the decriminalization and compounding provisions. Out of the 12 provisions, out of the 12 sections under which there can be prosecution under GST, 3 of them have now been removed. All of those 3 were non-cognizable and bailable offences, so they were the smaller offences in that sense. The larger offences have largely remained untouched, and they still attract prosecution. Having said which, the threshold for launching prosecution has been increased from 1 crore rupees to 2 crores of rupees, except for certain transactions dealing with falsification of documents and furnishing of false information. So that's been a welcome step in terms of saying, do please decriminalize and reduce the risk and reduce the threat of harassment that companies have faced. I dare say this is a little bit of a, well, it doesn't go as far as I think people would have liked in terms of what's the relief that they were looking for from decriminalization. But let's hope and see if we actually see some more relaxation as we go forward. On the compounding side, which is the SSEs, in that sense, buying peace and buying their way out of the problem, that's been simplified somewhat. The amounts payable for compounding have been reduced. So from 150% of the tax amount, it's now reduced to between 25 and 100%. It still remains a once-in-a-lifetime opportunity, and there still is a restriction for using compounding for fake invoicing cases. But nonetheless, I think this might be a useful sort of exit route where problems have happened and for taxpayers who want to choose compounding. There's been a big set of changes on the e-commerce side. Some key definitions have been changed, as also, sorry, my apologies. 122 deals with the penalty for e-commerce operators. 122 is the section on penalties. And what they've done is they've increased the responsibility of an e-commerce operator to make sure that those using their platform for e-commerce transactions aren't actually falling foul of any of the requirements. So, for example, somebody who's unregistered, unless free from registration, or somebody who is, carrying out an activity which he cannot conduct, for example, an interstate supply, or if there's non-furnishing or incorrect furnishing of documents, would actually now all render the e-commerce operator liable for penalty also. I think this industry would see this as a harsh step because through COVID and given India's IT revolution and the penetration that e-commerce has enabled, one would have thought that this puts a somewhat too high a level of onerous risk on the e-commerce operator. Let's see if this provision gets diluted. I believe representations have gone to the government. As the finance bill makes its way through Parliament and gets passed, it remains to be seen if this gets diluted. Sticking with the theme of sort of digital services and digital tax, there's been a further widening on the scope of online information and database services. So the amendment does away with this requirement of human intervention. Now, what that does is potentially open up a can of worms in terms of saying that literally anything which has a digital footprint might fall within the definition of online supplies. And there are several examples of this, right from games which are being played, so games being downloaded by users in India, or we got a recent situation of a concert. It was an online concert and tickets being sold for an online concert, or even something as, in a sense, settled as online education, where you had online classes, and the question was, when you have some element of human intervention, when you have a physical guest lecturer for some of the lectures, would that put the service outside the ambit of online services because there's a distinct human element? What this amendment now does is, like I said, potentially risk everyone who has an online footprint or is operating through an online footprint and exposes them to tax in India under the online provisions. The definition of non-taxable online recipient has also been widened. Otherwise, earlier it was specific to governments and private bodies. It now says anybody who's unregistered becomes a non-taxable online recipient. And finally, as far as exports by an unregistered person are concerned, the transport that such a person might undertake, which otherwise would have not been liable to tax, will now become taxable in India, even if the goods are destined outside India. That's through the proviso to section 12(8). Some of the other key amendments to the GST law, and these have a wide sweep in terms of what they cover. The first is, and this is quite important and circles back to the point I made about audit and surveillance and investigations, which is that a separate section is put out enabling the sharing of information collected from the GST portal with other branches of the tax and regulatory arms within the government. What that therefore means is, you could face more inquiries in terms of anything which is seen as a mismatch of data. Certainly, it's a good system to have if it actually helps bring about tax compliance. The fear remains that this might lead to unnecessary litigations with the department or locking of horns in terms of anything which amounts to a mismatch. But this is key. It sort of circles back to the point that was just made about use of a PAN and this whole issue of centralizing and all of the tax authorities, the revenue authorities, and the different regulatory bodies having access to taxpayer data, SSC data at the click of a button. So all of this is a step, are steps in that direction. Then the next point which you see on your slide is the retrospective amendment under the exemption schedule, where for supply of goods from a non-taxable to a non-taxable transaction, the triangulation transaction, as well as warehousing transactions, we had clarifications on this to say that they won't be taxable. This is one of those retrospective amendments which have been made to actually put this issue to rest, to say that these type of transactions will not be taxable. There's a potential twist in this tale, which is that there could be a reversal of credit required for certain types of warehousing goods. An enabling provision has been taken by the government here. It remains to be seen whether all types of warehouse goods will trigger this credit reversal, or it's going to be a restricted list that the government brings to this. Section 10 deals with restricting the use of a composition levy. That's a minor amendment, but relevant for those who are in the composition space. For those claiming interest, there's now a potential restriction in terms of how much and for what period you'll get the interest. The government has been given the powers to, in certain cases, limit the amount of interest made available on the refund by making it subject to certain conditions. So otherwise it was an unconditional post the 60 days of the refund application. It would have been an automatic triggering of the interest clock, but now that's been made subject to certain conditions. The time limit to file refunds has now been fixed at 3 years. This links to the amendment made last year in the provision on how interest gets triggered in terms of delayed filing of returns and declaration of output tax in a delayed return. Section 23, the amendment was clarificatory because there was a potential dichotomy between whether a compulsory registration was required under certain circumstances, but 23 has put that to rest. The last change that you see on your slide is somewhat of a disappointing one. Corporate social responsibility is an obligation for companies under the Companies Act. It has now been legislated into the GST law that expenditure on CSR will not be creditable. Now, this remains contrary to certain advance rulings. It throws open the question of whether this is retrospective or prospective, or can one take the position that because this amendment has come now, it sort of cements the position that credit on CSR was validly taken before, and actually principally contradicts the proposition that anything used for business should actually be creditable. Again, this goes back to the point I made earlier about, we still have a bit of a flawed credit system in terms of the restriction that you have. Still some more unresolved issues. All the points that you see on the screen, and I think several of those are very important for those operating from outside India. And these have not sort of, in the bill, didn't see that much traction. The first is setting up the tribunal. We don't have an appellate mechanism in place. Of course, since the time that the finance bill was passed, the GST Council did meet, and the recommendations of the group of ministers has been accepted. So we now expect to see the tribunal get set up very quickly. They're talking about a principal bench in Delhi and state benches. They also seem to have figured out the constitution of these benches, saying that there will be at least an equal number of judicial members to technical members. So that should address some of the past litigations we've had on this. 2 points which I want to flag with you, on which we still don't have the necessary certainty. The treatment of secondments, the northern operating system judgment of the Supreme Court, which again a lot of people have been troubled by because it raises some very fundamental questions in terms of when a secondment arrangement might trigger a reverse charge as a manpower supply. I think there still is sufficient, ambit to say that it doesn't have to be followed as a carte blanche. There still are situations where the reverse charge will not apply, but certainly some unwelcome uncertainty there. Likewise, on the intermediary services, that's getting settled more through the courts. We didn't see the sort of amendment that we were expecting to see in the law. And finally, on transitional credits, I mentioned to you we had the Philco judgment, and following Philco, it looked like transitional credits have been sort of put to bed and everyone will be able to move their credits over to GST. But we are seeing now, as we come to the end of the period for verification by the GST department, we are seeing a situation where several of these credits which have been claimed under the IST, despite Philco and despite some of the judgments of various high courts, including the Bombay High Court, are still getting challenged to say that the credit has not been validly transitioned. I'll quickly take just 2 minutes to talk about some changes on the customs side. Again, the customs changes are in this climate of waiting for the new foreign trade policy. It's been several years of delay now. For the last 2 years, we've been sort of saying that we expect to see it, but I think the latest announcement talk about perhaps April or shortly thereafter. Key things in the FTP are going to be the setting up, or rather the enablement of district export hubs, e-commerce transactions getting a push, and R&D centers in India, a thrust for them in terms of some FTP benefits that might be available. The customs provisions, on the other hand, have been getting relaxed on the one side and getting stricter on the other side. So earlier this year, in Jan, in fact, and it became effective on the 11th of Feb, we brought in a new set of rules to prevent undervaluation, which puts a further onus on importers for certain types of goods in terms of additional declarations that they need to make, in additional testing that the goods that they import might undergo, and certain checks that might get put up. So we still have to see, these provisions play out in their entirety, but that's certainly one more thing that importers need to do. Linked to that has been the Karotar and the FTA obligations. India has been signing very many FTAs. We do wait to see if the India-EU FTA gets signed this year, as well as the India-EFTA agreement gets signed here. Both of these have been some time coming, but we've been hearing from the Ministry of Commerce that there's been substantial progress and, fair amount of evolution, and several key issues have been resolved. So I think from a German perspective, the German region perspective, I think both of these could be, FTAs of relevance for trade with India. Those, like I said, have the Karotar obligations. Again, declarations and information to be kept by importers in terms of being validly availing the Karotar benefits. We've seen growing use of the mover and the AEO, which are customs relaxation schemes. Again, in line with the idea of the government to ease doing business in India, reducing the footprint of customs duties, rather than giving them refunds to exempt them fully. And the AEO, of course, an international program which India has taken quite seriously, and we now have several clients and companies in India at tier 2 and tier 3 and taking the benefits of those. India has also used an increasing amount of trade remedy measures, and the interest, and it's a coincidence that the EU has been actually thinking in the same direction, that it's more anti-subsidy and countervailing measures which are sort of top of mind for regulators in the EU as well as in India. So while India has been quite active on anti-dumping measures, it's now anti-subsidy measures of late, which have also been seeing a fair amount of action. And finally, we were expecting an amnesty under customs along the lines of what we had in 2019 for excise and service tax, just after the introduction of GST, but that's something which didn't come through. So very quickly, turning to the amendments that have been proposed in the finance bill, we have significant reductions of BCD rates. Those, of course, will vary by chapter depending on which line of business you're in. The thrust there has been growth orientation for India, increased manufacturing in India, and supporting strategic initiatives like, green energy and manufacturing and so on. And to end the last key point, which is regarding the appellate procedure for trade remedy measures. Here we've seen something of a move away from what the courts were ruling. So what we have, just to give a quick background on this, is we have the Ministry of Commerce, which actually undertakes trade remedy investigations and make recommendations to the government, which are then ultimately enacted through an imposition of duty by the Ministry of Finance. And we've seen several situations where the recommendations of the Ministry of Commerce weren't being followed through in terms of duty impositions by the Ministry of Finance. And the experience over the past few years had been that these are challengeable in courts, and the courts were willing to step in and say that if such an investigation report has been made, such a conclusion has been reached, then perhaps it should follow through with a duty measure. What this amendment does, and it does with retrospective effect, is to actually say that the actions of the government in terms of deciding to impose or not impose any of these trade remedy measures is actually not subject to challenge. So this rounds up actually the GST and customs changes. Like I said, a lot of them had to do with the overall climate into which these changes fit. As it's been for the last couple of years, it's been a mixed bag with the indirect tax changes, but I think on the balance of things, people have generally been quite happy, but we can always hope for more. And we've seen in the case of the setting up of the tribunal, perhaps we might see some further relaxations and further, help given to businesses as the finance bill actually goes through its passage through Parliament. So thank you very much, and I'll look forward to taking any questions at the end of the session.
Thank you so much, Mr. Choksi, for the very detailed explanation. I'm sure there are more questions coming to you. Our next speaker for today is Mr. Moin Lada, who's the partner for corporate and commercial regulatory and securities for Khaitan & Co. from Mumbai. He will give us the overview on the regulatory developments, and with no further delay, I'd like to hand it over to you, Mr. Lada. Thank you.
Thank you very much, Maya. Good morning to everyone in Germany, and good afternoon to our participants from India. So I think a lot of points have been covered, so I'm going to keep my session very specific and short. What I plan to cover is a few regulatory developments that have happened as part of the current budget announcement, and how these will really work to ease, the doing of business. So for the first amendments, and this has been a consistent approach that the government has been taking, is simplification of KYC. So as we know that know your customer has been very important for all financial regulators to be able to establish the identity, to establish the authenticity of the customer's identity and the beneficial owners. At the moment, we have a set of rules and we have a system in place which is applicable across organizations, across companies, depending on what you're really doing or what relationship you're establishing as a business in India. What the government is now proposing is to have a risk-based approach. So instead of a one-size-fits-all approach, it will really be basis the type of business, the type of risk element involved, the kind of exposure for the public at large or for the investors involved. They would have a separate set of documentation, a separate set of KYC, and a separate level of examination. So things that really don't deserve to have a detailed scrutiny will be able to get around with a more sort of easier system in place. The businesses which are, for example, financial services or businesses related to the securities market, all of those would still continue to go, with the more detailed level of KYC, obviously with the intent to prevent money laundering, any sort of, illegal activity, financing, etc., and ensure compliance with all international standards that are applicable. So this is what they are looking at doing. In addition to this, the government has proposed having a unified system which can, sort of be worked around in a way that once the KYC is done, all regulators can rely on it and access it, and there's a uniform system, obviously with the risk-based categories, but eventually it's a uniform system. The second aspect really is that our Ministry of Technology had already gotten a flagship initiative of a DigiLocker. Now, what this has facilitated for individuals really is enabled them to store their documents and their identity proofs, their government-issued permanent account numbers. All of these documents are stored and are able to be accessed and produced as evidence as and when demanded in a soft copy and with an application which is DigiLocker. The scope of this is now intended to be widened in a way that it will now be able to be used by organizations, by companies, by MSMEs, and the number of documents that can also be there in this DigiLocker is also intended to be widened. The third related amendment really is that the permanent account number, which is your tax number which you register with the income tax department when you are going to be a taxpayer or you're going to acquire an asset in India or shares in India or have a bank account in India. The first step is to take a permanent account number. Even as a foreign company or a foreign investor, when you set up a company in India, after your company is set up, to be able to open a bank account, you'll first obtain a tax registration with the income tax department. This number is now going to act as a common identifier for multiple government agencies for identifying a business organization. At the moment, as we speak, there are about 13 business identifiers. Your employment provident fund organization number, your GST number, your tax identification number, tax collection number, all of those lead to multiple documents, multiple options, multiple levels of evaluation by different agencies. Now having PAN as the common identifier eases the process not only for the government but also for the businesses as well as agencies that are evaluating this document. And another element, another step which will, in my view, will really ease the business is having a central processing center for certain filings under the Companies Act. So I'll share a few examples. For example, today, if you were to have set up a financial services company in India, you will do a filing with the Reserve Bank of India, and you will do and when you go for setting up the company, the Ministry of Company Affairs and the Registrar of Companies would pop up with a question that where is your no objection certificate. So all of these things lead to multiple filings. Similarly, if you're closing or setting up a branch office in India, you need to have a separate filing with the concerned regulator and another filing with the Registrar of Company through the MCA portal. Now you will have a central processing center for such overlap filings. So instead of multiple documents, one document file will be accessible to both the regulators, and therefore you will be able to have a more simplified process and a simplified system in which you will be able to complete your process. So these are three changes which I think really will ease businesses. There are a few more regulatory changes that have been proposed. So as you know, and I'll just quickly for everyone's benefit, we have two very relevant acts for our banking system. One is the Banking Regulation Act, which really regulates the functioning of businesses, licensing the banking entities in India. And we have the Reserve Bank of India, which sets rules, regulations, and directions and systems of how the Reserve Bank will function and create its rules and laws, right? There is an amendment proposed to both of these, specifically with the intent to improve the governance at the banking level, at the Reserve Bank's level, and enhance investor protection. There is going to be a consultation paper that will be floated around, and basis this consultation paper, there'll be public comments that will be sought of, and then new rules will be implemented. So this is another step which will be specifically focused on the banking industry. As I think Udayan already mentioned, that regulatory compliances, decriminalization has always been on the list for each budget that we've been seeing over the last few years. And this being the Amrit Kal budget, as the government likes to call it, they have done that again. And I think I wouldn't repeat it, but a few of the GST related changes, which are more procedural, have been decriminalized. So that just bring a certain amount of comfort for foreign businesses, for entities or investors looking at investing in India, that unless there is a very, very critical non-compliance, you are at least away from a criminal action or from a criminal exposure for the people in control or the officers in control. Now, the last step, which I think is the key step, is that the government has also now proposed to set up a national financial information registry. And what this is really going to do is it's going to really bring in all the information from the Reserve Bank, from the Income Tax Department, from the GST Authority, the Securities Regulator, all in one place. And this will give a complete view to any credit institution or anybody looking at the relevant entity or the relevant business in terms of what has been their compliance status, what are the actions they've taken, what is their exposure, what are the qualifications or disqualifications, what's been really the track record. So this will really be a one-stop shop to get a complete picture of, and one registry to get a complete picture for a regulator, for a banking institution, for a lender. So a framework will obviously be put in place, but this will give a complete 360-degree, sort of perspective. Moving on to our pet project of our government and one of the favorites, we've always been seeing liberalization and multiple relaxations and measures being undertaken at the GIFT City, our one of the first Indian financial services center, or free zone as I'd like to call it, and multiple changes have been proposed again to make the GIFT City more attractive, as well as ease a few of the businesses which they were based on public comment. So we've seen a lot of funds and financial institutions being set up out of the GIFT City. So one of the first changes is that offshore derivative instruments, ODIs as we call it, can now be issued out of the GIFT City itself, which and a related clarification is a tax exemption if there is a distribution to the actual unit holders. There'll be an avoidance of double tax, and there will be a tax exemption in the hands of the people receiving the funds, really. So effectively, the unit holders, when they receive the money, if the fund has already paid the taxes, they wouldn't be double taxed. There's a single window that has been proposed for getting clearances, as we know, and there's a related point here, so I'll try to merge that. As we know that while initially the GIFT City was separately regulated by the Reserve Bank of India, the Securities Exchange Board of India, the Insurance Regulatory Authority, etc. But eventually in 2020 we got the IFSA, and the IFSA acted as the the one-stop shop regulator in the GIFT City itself. Now the powers for a special economic zone related compliances have also been delegated to the IFSA. So this makes it much more easier for businesses which have exposure with the SEZ Act to also be able to go directly to the IFSA if they have an they're setting up a shop in the GIFT City itself. The acquisition financing, which has otherwise been challenging in India, is also now being permitted in the GIFT City. Another very unique point is having setup of data embassies. Data embassies, as we know, is basically a structure set up where a country overseas wants to house its data in another country, but retain its own control and retain its sovereign immunity, just to sort of deal with any critical situations where they can't access such data and such confidential information in their own nation. This could be due to some sort of a war, natural disaster, cyber attack, military invasion. So these kind of data embassies can now be set up in the GIFT City. Last but not the least, the tax benefits that are already available, the tax holiday, the lower tax rates, etc., in GIFT City are going to continue till 31st March 2025. Also, the Exim Bank, which is a very key institution in promoting export, import, and providing letter of credits to importers exposed to India, a subsidiary of this bank is also being set up in the GIFT City. So to sum up, really speaking, the government has proposed multiple steps which will not only ease business but also create a lot of opportunities for foreign investors and FDI into the country. The real aim seems to be to reduce the the compliances which are redundant, ease KYC and measures for setting up businesses and starting your actual operations, provide GIFT City as a platform where you can continue to avail tax exemptions, get single window clearance, as well as have other benefits of being able to take a faster route to enter a faster route to enter this this IFSC set up by India. So all in all, while all of these have been proposed, there are a few things that one needs to consider. On the first aspect of KYC, DigiLocker, and other developments, one thing that the government is considering is expanding its own IT infrastructure so that it can accommodate the additional load or the additional sort of pressure that will be, that the systems and servers will now have to deal with because of the DigiLocker expanding its scope, as well as, setting up all these information registries and amendments to the law are all being done in consultation with the public and the industry players so that it really brings the desired impact. I think that's really what I wanted to bring to you guys from a regulatory perspective. I think my colleagues both Gaurav and Udayan have already explained the impacts from a direct and indirect tax perspective. So we'll be very happy to take any questions around this. Thank you. Maya, over to you.
I think in the interest of time, I'll just take one question per speaker now. I'll begin with you, Slara. So the question to you would be, is KYC challenging in India, and what is that the foreign investors should consider to avoid any unexpected delays?
Okay, thank you very much. That question's to me, Maya, right?
Yes.
So yes, I think KYC per se in India is challenging. And therefore, what one should do, depending on the structure they're using to set up their business, whoever they're consulting, whoever their advisors are in India, they should already share their structure, get a heads up of what are the documents that will be considered as eligible documents, and already commence the process for consularization or apostille, as the case may be, depending on your jurisdiction, so that you have all the documents ready. And you don't wait to start that process, because getting a consularization itself could take about a week or 2 weeks. So once that process is done, because any advisor or anyone who's dealing with Indian laws on a day-to-day basis would be aware of where the roadblocks are, what's really going to be a problem, whether you have audited accounts, whether you have a certain level of data, whether you're really using the entity of substance, whether we're going to look beyond that entity, how complex your structure is. If all of that is studied in advance, that really can help you to deal with all the challenges, and also sort of be aware of the realistic timeline of when you'll be able to actually get on the ground and start your operation. Thank you.
Thanks for that, Robert. Gaurav, a question to you would be, when should the company really start working on the local file to ensure timely compliance?
Sure. Thanks, Jamli. So I think on the transfer pricing documentation, really the starting point should be as soon as you actually plan to enter into India. So first thing is something where you need to decide what are the pricing you need to set. So this is something you need to decide before even entering into India or before even entering into an international transaction. So that's step one. On the local file specifically, as soon as the year end closes, say financial year in India is from 1st April to 31st March. So as soon as that period closes, you just start preparing those documentation or local file during the audit proceeding as well. So this is something which can be again reviewed by the transfer pricing auditor also. And at the max, this should be completed before filing of Form 3CB, which is the transfer pricing report, because that is something which is required under the law, and this is a contemporaneous document, so every time you need to keep on updating those documents.
Okay. The last question for today to you, Mr. Choksi. What exactly should the assessees do in respect of disputes awaiting resolution before the appellate tribunal?
So I think like I said, I think we should expect to see the tribunal get set up later this year. And we've seen significant momentum from that last council meeting. The GO recommendations have actually come through. So unless it's a matter of real urgency, I think it might be wisest to just sit it out, because it might be a few months, hopefully, by which the tribunal is set up. The reason I say that is you can, of course, go to court even now, and in fact, we had some reports recently of the CBIC saying that they will not try and contest assessees who are going in writ petition because the tribunal has not got set up. But having said that, I would say why sort of forego one level of appeal by going to the courts now if you can wait a couple of months and then get relief through the tribunal. So unless it's urgent, sit it out. Otherwise, yes, you can move the courts and you won't be stopped from it.
Right. Thank you so much, speakers, for the kind presentations. I think it was quite detailed. And of course, the presentation will be shared with the attendees, and a contact will be on the presentation. So we will reach out to you directly if there are further questions. So I'd like to just sum up our discussion. So broadly, bearing some expectations, the recommendations in the budget are aimed at ensuring stability in tax collections, simplifying rules to lower the cost of compliance, encouraging the entrepreneurial spirit by decriminalization of laws, and to give tax relief to individuals. The budget is growth-oriented, taking emphasis on infrastructure development, green growth, and inclusive growth of the nation. The finance minister has done an excellent job in balancing collections and spending and has tried to cover all the sectors in the budget exercise in order to achieve the long-term objectives of the government. Overall, the budget has been pragmatic and guides a strong growth path for India and has been an attractive destination for the foreign investments to come in the years. We'd like to take the opportunity to thank the Embassy of India, Ketan & Co. and Rödl Partner for the support for organizing this session today. Thank you, dear attendees, for being so patient with us. And as we draw an end to the session today, we'll definitely keep you posted on the sessions coming up shortly. Until then, stay safe, stay healthy. Namaste.
Thank you. Thank you.
Thank you.
Thank you. Bye-bye. Maya, are you able to hear me? Do we have any questions really for any of us, Maya? I don't hear you yet. I don't know if it's my issue or if any of the others can hear you already. Odin, are you able to hear her?
No, I can hear you, Moin. I can't hear Maya. I
Okay.
think Jamli, I think it is.
Yeah, I think there are issues with her microphone. We are trying to fix it at the moment.
It's audible now.
I think we can hear you, Jamli, now.
Yeah.
But
Thank you.
very, very quietly.
Okay. All right. It's audible, right? Even if it's a little feeble.
Yes. Yes, we can hear you.
Yeah. Thank you.